This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion.
Let's go ahead. Summer 2021. The summer of COVID part 2. A little bit of a mega trend following episode. First, John Bollinger. He needs no introduction. Everyone knows of Bollinger Bands. Second, Catherine Kaminsky. Check her trend following book out. Number 3, Brian Proctor, one of the original turtle traders, along with Jerry Parker. Number 4, Christopher Cruden, a unique trend following trader and doing it a unique way. 4 unique voices. Now, maybe you heard these a little bit of time ago. Maybe you did not. 4 great refreshers for a world of mega uncertainty. I mean, look, there is absolutely not a damn way to predict anything in this day and age. There never really has been, but for sure, we all know it now. So here's the deal. If you don't know what's going to happen next, and you need to trade, and everyone does, and you need to make some money, and everyone does, then how the blank do you buy and sell and bet the right amount on the right markets? That's Trend Following 101. That's what these 4 guests today bring to the table. I hope you enjoy these conversations with John Bollinger, Catherine Kaminsky, Brian Proctor, and Christopher Cruden. Today on the podcast, I have John Bollinger, the John Bollinger of Bollinger Band fame. One of the technical indicators that just about everyone has heard of or known about, even if they don't know much about it. John has been popularizing price-based indicators, often with his name, since the early 1980s. I look forward to this conversation, and I hope you enjoy. Yes, this is Mike Covel. I'm supposed to be speaking with John this morning for an interview.
This is he.
Hey, John. Mike Covel, how are you?
I'm well, and yourself?
I'm not too bad.
Having walked in the same circles for many years, I don't believe we've actually ever met.
No, I don't think so. And I'm actually surprised at my inattentiveness to miss out and do a bunch of podcast episodes and not ask you already to begin with. So
No problem.
I saw you come up on Facebook and I was like, oh my gosh, hold on. We're connecting on Facebook. What's going on here? Why have I not asked John?
I don't know. You said something interesting, I think.
What did I say?
I forget. You posted something and I thought it was interesting, so I responded to it. I can't remember exactly what it was.
Well, listen, I want you to define, if you can for me, and I know you can, I want, and pretend this is a non-technical audience, but just give the classic Bollinger, and I'm going to get back into the details. I want to kind of know how this all unfolded, but the classic Bollinger Band indicator, and describe it, if you can, for the layperson. And even for the intermediate understanding, just what is a Bollinger Band indicator for folks out there?
So, Bollinger Bands are simply a kind of trading band, and all trading bands serve the same purpose. They define whether price is high or low on a relative basis. By definition, price is high at the upper trading band. By definition, price is low at the lower trading band. And traders can use that information to make rigorous trading decisions, to take the emotions out of the trading process. Bollinger Bands use volatility to determine the width of the bands. So that means they're highly adaptive to changing market conditions. When the market's quiet, the bands will be quite tight, and so the definition of relatively high or relatively low will be quite close to the current price structure. When there's a lot of volatility and the market's trending very strongly, the definition will expand dramatically, and it will keep our definition of relatively high and relatively low germane to the price structure. And the sort of magic mechanism in there is a volatility calculation called standard deviation. If you were to look inside the math of standard deviation, you would see that there's a mathematical process called squaring. And it takes the small deviations from the average and squares them. That's the key mechanism of standard deviation. When price is close to the moving average, the deviations are small, and the measure of standard deviation is very small. But as price starts to move away from the average and the deviations get larger, that mechanism is working away in there, and it's squaring those larger deviations. Now, if you square a small number like 2, you get a slightly larger number like 4. But if you square a larger number like 10, you get a much larger number like 100. And it's that squaring that makes the bands so responsive to changes in the price structure. And that's sort of the magic behind Bollinger Bands.
John, when is the first date that you put the Bollinger Band, the original concept? I know there's been different versions and iterations over the years, but the very first time, early 80s, 1980, 1982, when did you put it out?
The very first version of Bollinger Bands, probably 1982. As you point out, it was an evolutionary process. I had one of the early microcomputers, and this was in the days before PCs, when, if you wanted a small computer, you sort of had to build it yourself. You assembled it out of boards that you would buy from various hobbyist shops. And I had one of those, and I was an active options trader. So, as you know, if you're going to be an options trader, you have to have a handle on volatility estimates. That's the essence of the business. And in those days, we had a lot of sort of very quick volatility estimating ideas. Half the prior, the immediately prior range, or we had a lot of sort of rules of thumb. But I wanted to do a little bit better. And since I had this computer and one of the very early spreadsheet programs, it was called SuperCalc, I started calculating volatility before each of the trades that I would make, so I could get a good handle on what was going on. One day, I calculated volatility, and I copied the formula down a row of cells. And I saw that volatility was changing. Now, that doesn't seem like something, very interesting today, because we all know that volatility is volatile and it changes over time. But back in the 80s, we didn't know that. We thought that volatility was a stable quantity, like a property of a stock. Like we said that IBM's beta was 1.2, and we just didn't believe that volatility was a dynamic quantity. Now, to give you a little bit of reason why I thought that might be so important, I was trading at the time using trading bands, and we're trading a very, very simple but very effective system at the time. It used the Dow Jones Industrial Average and percentage bands, 4.5% above and below a 21-day moving average. And we would compare price action inside those bands to the action of a couple of oscillators, an advanced decline oscillator and an up and down volume oscillator. And it was really a good technique at the time. It had very good risk-reward ratio. nice percentage of winning trades versus losing trades. Good system stats, although we didn't even know they were system stats in those days. But the problem is that as the market changed, you would have to change the width of the bands. And, sometimes 4% bands would work, sometimes 5, 6, 7% bands. And if you traded stocks instead of the Dow or something like that, then you'd have to constantly be calculating the bands and trying to figure out how wide to make the bands. And we did this by using a tissue overlay on a chart. We would, draw a chart, and then we'd take a piece of tissue and trace the moving average and slide it up the piece of paper so that it would touch all the highs, and slide it down the piece of paper so it would touch all the lows, and then figure out what the best bandwidth at that time was. The problem with that is that you let emotions into the trading process. If you're bullish, you set the bands to present the bullish picture, and if you were bearish, you set the bands to present a bearish picture. So I was looking for a way to automate the changing of the bandwidth. And when I saw that calculation for volatility changing over time, I went, wow.
Light bulb moment.
Light bulb moment. And that was probably in the middle of 1982, maybe a little earlier. It took me a little while to sort out the details, but very shortly thereafter, Bollinger Bands, as we know them today, were born.
Let me get you to get into a little philosophy of you, because I want to understand what you were thinking, what was driving you, where was the creativity coming from? I saw in your background, which kind of surprised me. I did not know, and I just doing a little homework today, I saw that your college education was not finance, was not trading. You came at it from a completely different perspective, and you might want to talk about that for a moment. But I'm curious as to what you think might have been some of your curiosity triggers. Why were you digging? I mean, a lot of other people just accepted things. So why were you innovating? What was going on in your head?
It's true. I didn't go to a university. I went to an art school, the School of Visual Arts in New York, and I studied cinema, specifically cinematography, although there was only a single course at that time. The film school there was relatively new. I had become interested in light some years earlier, and had kind of studied the properties of light and the way light combines and affects people and emotions and such like that. And I had worked in various media type jobs and such. And I got more and more fascinated by film itself. But light was my introduction to film, and then I got just fascinated by the sorts of things that you could do with film. And rather than become a traditional, cameraman, I became the sort of guy who worked in special effects photography. I wanted to do like movie magic. Of course, my entire skill set has been obsoleted today by a process we call computer graphics. But in those days, you did most of that in the camera. And I was really interested in, the ways that you could fool the eye with the camera. So I had a career of 10 years or so in the movie business, most of which was spent with, focused on high speed and special effects photography and such like that. So I guess I brought that, a similar approach to the markets as I made a long transition from the very late 70s into the very early 80s from the business of cinema to the business of trading. I'd always been interested in markets, and I just got more and more interested. Part of part of the puzzle was that computer I told you about a little earlier. I had actually bought that and put that together when I was still in the film business. A partner and I owned a grip truck, which is one of those trucks you see parked at every movie location, tractor trailer with about 60,000 items on it. And we were trying to keep track of the inventory. As you can imagine, it could be a problem. So we bought this early microcomputer and a copy of DBase 2, one of the first database products, to try to keep track of the inventory. And at the time, I was getting more and more interested in the market. I kept looking at the computer and kept thinking there must be some way that computer can help me in the market. I started out doing fundamental analysis like everybody does and got quickly disappointed like many do, and was looking around. I heard about technical analysis. I read Schaubacker, and I read Martin Pring's first book. I read Edwards and McGee and Robert Ray, the Dow Theory, and the more I read, the more this sort of stuff appealed to me. And in those days, it was actually very hard to get your hands on any information about this. So there was a bit of a chase about the entire process. It was really hard to learn this stuff. You had to find people. And finally, I found a trader, and I apprenticed to him for a year for no wage whatsoever. I kept his charts in real time for him for a year and learned technical analysis that way. That was kind of how you had to do it in those days. There was no internet, and none of this widely available information that a young trader can get now. So.
But I think that attitude, though, that curiosity attitude, the desire to be an apprentice, I sometimes wonder today if young people still realize that the game of life, the game of success, is still taking those chances. And so I think some people get so preoccupied with like, well, what's my salary? What's my salary? And here you're saying you're one of the guys that one of the most successful careers in this space, and you're like, hey, hold on, I worked for a year for free. I just want it to be close to the action. I just want it to learn. Yeah.
Well, and actually, I think a large portion of that is still alive. You go into any college these days, any university these days, and these kids are taking a lot of internships, and they're unpaid internships. And some of those kids, not all of them, but some of the kids actually have the right idea. They're looking to, really learn and sponge up and grow in a real world environment. They realize that, the education they're getting in college is just that, an education, and they need some real world experience if they're going to do something out there. So I'm not certain that sort of idea is dead. And, another great example, all the startups you keep on seeing popping up out of Silicon Valley in the tech world. I think a lot of people are really willing to take some chances and try to do something great, whether it's just something great on a small level for themselves or maybe perhaps something great in relation to the world.
I've had a ton of questions here that I want to ask, and what's so cool is you've been answering most of them before I ask. But I saw one comment from you, and I think it's a great, simple thought where you said the best authority is the price itself. And I'm curious, as you look back on your career so far, and obviously you're still, knee deep in the middle of this business, the best authority is the price itself. How accepted do you think that simple comment with quite a bit of depth behind it, how accepted do you think that statement really is in the world of markets and market players?
Not very well accepted at all, I don't think. I think a lot of people are grumpy about that idea. Take, for example, the idea of the fundamental analyst. The difference between a fundamental analyst and a technical analyst is quite simple. The fundamental analyst goes and examines the company's books and, the macroeconomic environment and competition factors and such like that, and comes up with a valuation for the company. Figures out what the float is and comes up with, a theoretical price that for the share that he thinks what the share is worth, say $50. And he goes out there in the market and, if the share is trading at $70, then he sells it. And if it's trading at $30, he buys it. Just as simple as that. But there's something behind that. What he's saying is that he knows better than the market. All right? He says that his estimate is correct. And he goes out to try to find out if the market is incorrect and take advantage of that. The technician does exactly the opposite. The technician studies price because the technician believes, or whether consciously or not, the technician believes that all the information in the system has been pulled into price. And by studying price, you can learn the most about a security. So they're just sort of opposing philosophies of how you approach markets. I believe in markets. Fundamental analysts believe in analysis.
I think sometimes too, price, describing it as you did, the best authority is the price itself, is a great way to describe it. But I think sometimes we all forget what price is. So maybe some critics might come out about technical analysis and they want to get into this and that. But the reality is the price is just representative of what the people are voting with their dollars for. I mean, it's just the people. It's the crowd. Isn't it the most direct representation of the crowd?
It is the most direct representation of the crowd, and it is also the price that you may transact at.
Yeah, it's like it's cutting to the chase.
So you may believe that what you're buying is worth something more or less than what you're buying, but the fact is that the market has set the price, and you'd better pay attention.
Let me shift gears on you a second. You've one of the few that, you've a lot of TV time. So, the big shows over the years have always wanted to have John Bollinger on. But I almost wonder how many of them really, you get your time to say what you want to say, but I don't know the acceptance. It's how do you see that? And you've been involved in the media so much in presenting your views and working in these environments. Is it somewhat like, you do your thing and then they go right back to 99% the fundamentals? How do you look at media and you presenting your messages over the years?
I think that the acceptance of markets and the acceptance of the price discovery mechanism, the acceptance of technical analysis or quantitative analysis has grown steadily over the years, and to the point where I think that there are probably more people paying attention to price than not. If you look out there in the literature and such like, you don't see that much new emerging in the fundamental analysis world. But if you look at the literature of quantitative analysis, or you look at the literature of behavioral finance, you see lots of new ideas coming up and lots of new methods and ways of approaching the markets being discussed. So I think that's sort of the most valid measure to see, where people are willing to put their time and effort into the process. If I were starting out now, I doubt that I would be known as a technician. I'm almost certain that I would be known as a quantitative analyst if I were starting out now.
Yeah, it's interesting you say that. I think that is a distinction. I think the word technical analyst and technician does seem to be morphing more towards the quant description.
I think it's true. The interesting thing is that the literature of technical analysis, and it's a deep and wide literature going back, well more than 100 years, is full of great ideas. And you can go back and read the old books. Not too many people bother to do that these days. I have a large library myself that I've accumulated over the years. But you can go back and sort through the old literature. And those guys really understood markets.
They were fabulous. They were some of the books from the 30s, 40s, 50s, fabulous.
Yeah, so you can open up almost any of those and pick out 3 or 4 good ideas. Sit down with somebody who's quantitatively oriented and say, well, look, can we build some rigorous approaches based on these ideas? And you'll find that you have all sorts of interesting ways to go.
Hey, John, I got to let you run, but I want to ask you one more question and let you tell the audience where they can find out more about you. But what are you working on these days that excite you? What when you get, because I can hear it in your voice, I can hear the passion. So what makes you get up every day? What are you most excited about these days?
I hate to say it, but I'm really on the same track from 30 years ago. I think that volatility is the most important, least analyzed, and worst understood aspect of the market. And, I spend my time thinking about volatility and ways that it can be used in the trading process, its properties. I especially like to think about how the ways in which volatility is misunderstood, especially by academics, and because that creates huge opportunity. So for me, the name of the game is the same as it was when I was an options trader, 35 years ago. Volatility is the key.
Yeah, I remember when I first saw volatility used in position sizing algorithms, and I had those light bulb moments. You're like, okay.
Now there's something, that, okay, you want advice for people? There it is. You just said it. Position sizing. This is the least understood and most important aspect of the trading process. It is almost nobody spends any time on it, and, everybody ought to spend lots of time on it. The size of the position can sink your operation or take you over the top for the same trading system. The same set of trades, you just vary the position size, and all of a sudden you turn a fabulous system into a disaster. So for me, if I had to suggest, an approach to anybody, I would say study position sizing. I think that's where the next really big innovations are going to come from.
Hey, John, I appreciate the wisdom today, and I enjoy the conversation. Hopefully we can catch up in person one day. And you're in Southern California today, I expect, yes?
Yeah, it's a little foggy this morning, but we're hoping for a nice day.
Hey, John, look, take care. I appreciate you taking the time today.
My pleasure entirely. Thanks for having the chat with me.
Take care. Today on the show, I have Catherine Kaminsky. This is Catherine's second visit to my show. She came on last year discussing her new book. Today, she's discussing a new white paper, specifically diving into correlation among traders. A deep dive, but a really important critical distinction that she makes in this new research. Also, Catherine recently joined Campbell & Company, one of the oldest, if not oldest, CTAs in existence, with much trend-following expertise dating back to the 1970s up to today, never stopped, a very successful firm. I hope you enjoy this conversation with Catherine Kaminsky. Catherine, today, and I think people really need to go back and listen to our first conversation, but today what I really want to get into is you've got this cool white paper that you put out at Campbell and Company called Return Dispersion, Counterintuitive Correlation, subtitled The Role of Diversification in CTA Portfolios. I really did not know what I was walking into as I started underlining and going through this about a 10-page white paper. But I started to realize there's something really interesting, and you're going to be able to kind of flesh this out. But over the years, I have noticed, and I'm sure other people have noticed too, that when there are big performing months in the CTA managed futures trend following space, that often managers that might have high correlation don't necessarily at those opportune times, don't necessarily always have correlated results right at that very opportune time for that particular type of strategy. Am I onto something? Is this where you were diving into?
What happens is you have a strategy space where most of the strategies are very diversified. So when you have such diversified strategies, we try to explain that therefore the correlation will be high between the strategies on average a lot of the times. But what happens is that specifically when people want performance, so a year like 2014, which is a great year for the CTA space, the strategy in terms of performance can be all over the map. That's kind of counterintuitive to a lot of investors who say, well, I thought that, A and B and C were all the same, but yet when I really needed and really got performance, A was over here, C didn't do anything, and B was, who knows, so I think this is sort of a counterintuitive issue in the CTA space, which has to do with the fact that momentum as a premium is a little bit, it can come in spurts and periods like 2004. And when that happens, it turns out that we tend to be those little differences between how we do risk management, between what we focus on seem to sort of be exacerbated in these moments.
And when you just said 2004, you meant 2014.
2014, yeah.
Let's before we dive into it though, let's take a bigger step back and let's just talk about, for example, because you mentioned this in your paper, 2014 was the return, so to speak, of these types of strategies. Now, for someone you've written a great book with Alex Gracerman about trend following with managed futures, but why don't you talk about the notion that how, just like within the last few years, we've seen the titles, these strategies are dead, and then all of a sudden they're back alive in 2014. That predicate to begin with is off. I mean, the media's understanding of these types of strategies is off to say that a down period, it's dead, and then when it has an up period, it's alive. But the reality is, anyone that looks at the performance track record of this style of trading is going to see this variability from the outset.
Yeah, I mean, I think it's a natural human tendency, especially for strategies where one of the biggest challenges that we have in the systematic space and in the CTA space is that if people see us as a black box, they're much faster to throw the black box away. It's sort of like the television that, it doesn't work. And some people's solution to that is to hit the television or to, so I think when you understand how the strategy works and you get used to it and understand how to use it over the long run, of short periods even long periods of underperformance, if they're not really, really out of the norm, would be expected for pretty much anything that you invest in. The same thing happens in stocks, but somehow we seem to be less upset about that. And I think that has to do with the fact that we understand and we feel like we understand how stocks work. So we naturally more accepting of drawdowns in things that we feel comfortable with.
You bring up stocks. Why don't we talk about diversification from a 36,000 foot peak for a moment and talk about diversification as commonly understood in the equity world, the benefits, how it works. And why don't you transition that type of thinking over to the CTA world in terms of diversification as well?
I think that's a really good point. Some of my colleagues and even in the past with friends in the CTA space, we tend to have a very different view about how we do diversification in the sense that we tend to focus mostly on risk. And we see that return, for example, is really difficult to predict. but risk is something that you can at least manage and control. And I think that when we deal with diversification, what we're trying to do is spread our risk across as many opportunities and use as much information as possible to predict the level of risk. And in rare cases, the predictability of return. I think that the standard traditional economic framework for dealing with stocks and bond allocation is more, you have a return target, and then you minimize your risk as a function of the return target. We sort of, from past experience, tend to think that diversification comes from allocating across risk. And a lot of the research has shown that risk is a much easier thing to sort of attempt to measure and attempt to control than return.
I think one of the interesting things you do in this piece as well is you say that, look, there can be one core, for example, if we're talking trend following, there could be one core trend following strategy. There could be varying levels of risk chosen. There could be various parameter sets. The timing of those returns could differ. And I think what's really interesting that you kind of a novel way of saying it is that one trend following strategy is conceptually similar to one stock.
Yes. And I really like that analogy, because what you can say then is if you invest in one stock, you have tons of idiosyncratic risk in terms of just the sort of noise and risk that you're not getting paid for. So if you have one way of investing in trend following, so one strategy, one set of parameters has the same level of idiosyncratic risk. And so how we build portfolios is to add as many of those as possible. That's why we have to be systematic. Because if we're not, then we have too much idiosyncratic risk, because the risk-reward trade-off in such competitive markets like futures, and I think you've probably had other discussions with people about this, trend follow one asset. It's tough.
It's impossible. Trend following one asset is buying and holding the S&P.
Yeah. So that's the issue, is that if you can't sort of combine those parameters into a portfolio, then you end up with too much idiosyncratic noise. So for someone who's new to this space, you can do a simple analogy and say, it's like one stock. If you invest in only Apple, you're going to be all over the place. You may have still an okay strategy, but the risk is going to be too much.
But from a diversification standpoint, though, I think the analogy is really cool. But the one stock is generally one stock. But even if, let's say, one particular trend following strategy employed by a manager is just one set of parameters, at least that performance stream is being generated by a diverse portfolio. Whereas, I think it's still interesting to make that comparison to one stock. But I guess it's not exactly a true one-to-one comparison. But I think for the purpose of getting people to think about diversification, correlation, et cetera, I think it's very useful.
Well, the reason this is such an apropos topic as well is that there's been a lot of discussion. I'm sure you've had discussion on this topic as well about, okay, well, momentum is simple. I can give you the rule, and here's the rule, and, that's all you need. And that sort of is a challenge, because we see investors asking us a lot of questions about, what's right for me? Should I have a very simple trend program with, very low fees, or should I have a highly diversified trend, non-trend, and complex, a hedge fund strategy? So I think this is another reason why I thought this was an important thing to think of now, because a lot of people are reading about trend following, learning it, and then thinking, well, I can just do this myself, or I can use this product or that product. And I think that the diversification is where the difference is. We have to remind them to diversify. No matter how they do it, it has to be diversified.
And even though you're at Campbell, and this white paper is on Campbell letterhead, you're really not prescribing a solution here. I think what you're more than trying to do is to generate a conversation, get people thinking about these issues, right?
Yes. And the reason for that is that, honestly, investors are heterogeneous. They have different needs, different wants, different solutions that work for them. But I wanted to sort of say more that they need to understand that diversification you have to have to be successful in the CTA space, and that there's definitely plenty of ways that you can do it, but it's important to remember that. And the other thing that we focused on, which really bothered me, was this conditional correlation issue. Because a lot of people, when they look at the correlations between managers in this context of CTAs, they assume that high correlation means that you're always going to get the same result. That's something that sort of has been sort of assumed. It's a causality, like, oh, high correlation means same results. But what we show is that high correlation breaks down in periods where you perform. So that means that the only way to protect yourself from that is actually to make sure that you're not just replicating the correlation, but actually diversified across a whole set of strategies so that you can replicate the performance.
You know, I used to make these eyeball correlations over the years, looking at managers, especially at these opportune months or periods. And you could see over time for a particular set, I don't know, maybe 2, 3, 4, would often, even though they could be separated by oceans and have no connection, they truly seem to be, even at the opportune times, their correlation in a good way was right there. But you would clearly see times and events where you'd be like scratching your head going, okay, I know there's leverage differences and parameter choice differences, and people are trying to time when they decide to slice their section of the trend, but you would still shake your head and go, something's unusual for. So I guess it becomes really tricky and interesting, and I could see the minefield of data to be crunched here. If you start to look at a large number of managers, it starts to get fairly complicated quick, doesn't it?
What I see is a challenge I used to be an allocator, now I'm at a CTA, is that one of the reasons I wanted to go and work at Campbell was because I'm on the front lines and I get to see all the information. And my ultimate goal is to help find better ways to explain these differences, to explain and understand what causes differences between CTAs and how can we improve our systems. I think that's the challenge for the investors, is that, we do look a lot alike, but not all the time. And that's something that, this type of result shows that it is actually very important to understand the subtle differences between managers, between products that momentum trading, between your system and your ones that you're invested in. And I think that gives some pat on the back to the manager selection people that, this is an important thing that they're doing to understand the differences. It gives some credit to the manager selection teams and the allocators in our space who really need to do a lot of hard work to sort of dig down into the details to understand how we are different from each other and what are some of the sort of key issues to think about.
It really is it's such a big picture, fascinating angle, because whether it's eyeball correlation or crunching the correlation in Excel, you really do see some high correlations, but you looking at the magnitude of the differences at those critical junctures is fascinating, because things do break down. Look, somebody might still have a fantastic performance, but then one of their peers might be head and shoulders above, and then you start to scratch your head and you say, hold on, the correlation is really high, but the actual performance, the absolute return is quite different.
Well, what we find, and I think, what this paper hints at, is that there actually are some slants and tilts in terms of how we allocate risk, which can drive these differences. And this is a little similar to some of the work that I had done in the past with Alex on styles, but ultimately we all sort of have a slightly different footprint in terms of certain small factors. So you can take correlation as an example. Let's say that one firm is very, very sensitive in terms of risk allocation to correlation. And then another firm is slightly less sensitive. When you have a really large change in correlation, for some period of time, this can actually cause a dislocation between those two strategies. But usually this dislocation is somewhat temporary, and it will last over maybe a month or two. So let's say something happens and it happens to be a situation where correlation is very, very important. And modeling correlation is good for this set of strategies. Then that set of strategies will outperform the others. But over the long run, what you see is that, it varies depending on what happens in markets. And it's very difficult to predict whether trends are going to come from correlated markets or if they're going to come from individual markets. And I think that's sort of the subject of current research that I'm doing right now. Because I think that is sort of connecting to risk management is a very important way that we can help understand our performance over time.
Or one last question for today, kind of a curiosity type thought on my own here. And don't beat me up if I don't recall if it's in your book with Alex on page 456. Don't beat me up if I don't recall. But what was the inspiration for this direction? What was the aha moment that kind of got you going down this path for this particular white paper we're talking about today?
For the white paper?
Yeah.
Yes, that's a very good question, because on page, just kidding. No, actually, we have a chapter called Return Dispersion. And this chapter is really, it's quite deep. And it looks at return dispersion in the CTA space and tries to explain that, return dispersion at the levels we see is to be expected between correlated assets. But one thing did stick out to me, which really sort of got me to think about this paper. There was a graph where we conditioned return dispersion, so how spread out managers were, as a function of volatility. All the plots on this point were very, very close together with the exception of one. And that one point was 2008. So it was almost like there was this one situation which just didn't fit into the norm. Now, granted, this was a yearly study. So if you go at a yearly frequency, you lose a lot of sort of short-term fluctuations, right? So I thought about that and it always bothered me. And then when we started looking at return dispersion at a higher interval, we came up with a really interesting metric to estimate correlation point-wise. So on a monthly basis. And you might have seen this in graph 6 in the paper. And when we saw that, what we saw is that implied correlation was very stable over time, but implied correlation just broke apart from time to time in our sample. So that's where sort of the thought came about. This one graph that really bothered me in the book. We didn't talk about it, but it always sort of stuck out, that one point. And then I went back and thought about it again and sort of came up with the results of this paper.
Yeah, because over time, over years, like I say, kind of even eyeball and even some Excel correlation. But I often looked at differences, and sometimes you could directly attribute those differences to leverage choices. But other times you just knew it wasn't a leverage choice. There was something else going on.
Yes, and I think the problem is, and we talked about this in the paper, the problem is that correlation as a measure is not a good way to capture let's say you have a return series, like a correlation series, where you're correlated all the time and occasionally that just breaks apart. If you have a rolling correlation, you won't pick it up. It just sort of will roll down and roll up again. You won't see it as one point causing the entire change in the entire series. It kind of muddies the waters. So when we did this by looking at the cross section on a monthly basis, it was funny because I had some allocators that said to me, I said to them, this is more like how it feels to allocate to CTAs. And they said, yes, this is exactly how we feel. Everything seems the same. And then 1 month comes around and occasionally we're not sure why they're so different. And that kind of told me that there is something to this explanation.
Everybody can find the paper as of right now on the Campbell website. I think this last line, though, I'm going to read. People can go read the paper. I think probably one of the best things is for people to even jump in first. Maybe I'll even say that at the introduction. They should read the paper first. But I love this.
It's only 6 pages, so that's good.
I love this last line, though. High pairwise correlations may underestimate the importance of diversification in CTA portfolios, leaving portfolios undiversified in critical moments for performance, end quote. And that sums it up. But that's a big That's a big thought. And I don't think a lot of people have really sat down and chewed on that one yet.
So I think what we could say is we say that, if you assume that all strategies are the same, you may miss out in the right moments. I mean, that's maybe an easier way to say it. But I mean, if you assume that all things are the same, you may miss something. So you need to dig a little deeper, and you need to make sure that you have a very diversified approach to investing in the CTA space.
Catherine, you have once again promised there are no free lunches. Where can we send people? I assume the Campbell website, which is campbell.com, right? Yeah,
they can just check out the paper on campbell.com, or if they have any questions, they're free to email me. My email should be on the paper and also, on the website.
Catherine, it's always good talking. Hopefully we can talk again when you write more cool stuff.
Great chatting with you, Michael.
I love skepticism. I'm one of the biggest skeptics. I mean, I know there's all kinds of funny business that goes on in the government. Look at the U.S. Federal Reserve. How much funny business went on in 2008, 2009. So I get being a skeptic. I understand. But once I know the story, and once the data matches the story, I'm not a skeptic. My second book was called The Complete Turtle Trader, about a very famous story of a man named Richard Dennis and his partner Bill Eckhart, how they took essentially non-experienced traders off the street, taught them to be trend-following traders, and it worked. In 1988, these students, nicknamed the Turtles, went off on their own. Now, all these years later, many of them are still trading today for clients. The cool thing is the experiment never ended. The trading never stopped. And it wasn't just the turtle traders, the trend-following turtle traders. So many other trend-following traders across the world have kept the so-called experiment going. Whether they were turtles or inspired by the turtles or never heard of the turtles, trend following has become accepted by those at least that have a pulse, those that have some intelligence. Maybe that makes it a fairly small minority still. Nonetheless, the turtle trader story was just fantastic. Nurture trumping nature. Teaching trend following, showing that trend following worked. It did, and it does. A skeptic reached out to me the other day, though, and they said, you used an example of Google in your book on the turtles. Well, that's wrong, because Google was not around then. So, if you make up something about Google, what else are you making up? Now, of course, he said that one example was most likely used by me to just show a current market, of course. The universality of trend following is what I was really showing. It didn't make a difference what one was trading in 1982, 83, 84, or today. As long as the market is liquid, as long as it trends, trend following works. So he fixated on that one thing, that Google was used as an example, and everything else in the book was invalidated because of that one issue. Now, that's no longer a skeptic. That's just crazy town. Now, that's fine. I welcome the crazy town listeners to my podcast. That's great. It gives me something to talk about. It gives me something to rile against. So for that, I'm fortunate. Yes, the book, The Complete Turtle Trader, my second book, is invalidated because one of the market examples used included Google. Today in the podcast, I have Brian Proctor. Brian is a managing director at EMC Capital. EMC Capital was started by Elizabeth Cheval. Now, unfortunately, Elizabeth is no longer with us, but she was one of the original turtles. So Elizabeth's track record starts in 1985, continues with her firm EMC, and EMC continues to this day. Brian was also an original turtle in the Richard Dennis experiment. He joined Elizabeth at EMC after the firm was started, and to this day, he continues
to help lead EMC as one of the original turtle traders taught by Richard Dennis. I hope you enjoy this conversation with Brian Proctor. Brian, Mike Covel.
Hey, Mike. How are you?
Not too bad. Not too bad.
You get up early. You sent me an email at 4:00 in the morning.
Well, I'm in Saigon.
Oh, you are? Okay.
So the real question might be, who was getting up early?
Well, I got up at 6 and I looked and I'm like, oh, I got an email 2 hours ago. I'm like, holy cow.
You're like, oh, wow, this guy's really off his rocker.
What's going on in Saigon?
Let's see. I've been doing this podcast for 3 years, and I've been in and out of Southeast Asia since early 2013. I came here on a speaking tour. I was living in San Diego, and then one thing led to another, and I said, wow, this is kind of a cool place. I can stay here. So now I do all these crazy podcast episodes from Southeast Asia, huh?
Wow. Okay.
Hey, I was trying to think when we met, and I was writing it down. I think it was June of 2010 in Chicago at an MFA meeting, if I'm not mistaken.
I think you're right. I think we met because we were listening to a panel that had my old boss, Rich Dennis, and some of the guys and girls that I knew very well up to talk about their experiences with the mentoring program that Rich ran.
Yeah. Well, obviously, and you were a part of that too. But let me jump in. So as a managing director of EMC right now, commodity trading advisor, managed futures player, long track record back to 1985. And since you just kind of brought it up, I think it'd be a good thing to start with the audience, and then we'll kind of bring things forward to today, because it is one fascinating, and I'm sure there's probably a side of you that's like, oh my gosh, I don't want to have to say anything anymore. But it's still so fascinating to people out there to realize, and I guess for you, maybe it feels like a long ago school program, but it just so happens to have been a school program that was a very successful one. Why don't you talk about, Brian, I'm really curious, your first trading moments, how you got started, and what led you to the Turtle program?
You know, like Rich Dennis, I grew up on the south side of Chicago. So when I graduated from college in 1982 with a degree in economics, I went out and there was a big recession going on, and I thought I was going to get into investment banking somehow. But as I soon found out, they were laying more people off in the banking industry in Chicago than hiring. So just by chance, I ended up playing a round of golf, and in my foursome was a guy named Everett Klipp, who ran Alpha Futures, a big FCM, a big clearing member at the Board of Trade, where a lot of locals would clear their trades. As I played with Everett that day, he was asking me what I was going to do with my life, and I wasn't really sure, and I asked him what he did, and he started to tell me about the trading in the pits of Chicago, and I had heard about it but never seen him before. So, I bugged him a little bit, and I said, I'd like to come down and see how everything works down there, and if, maybe find a job down there. And he tried to dissuade me from coming into the business. He goes, no, you don't want to get in this business. It's a bad business to get into. Lots of people start in this business. They lose money. I wouldn't suggest it. So he kind of put me off. But I wouldn't take no for an answer, so I kept calling him, and finally invited me down to his office and showed me around and took me down to the floor, which was a tremendous experience. I'd never seen it before, and the minute I walked down the floor, I realized this is what I wanted to do. It was just that overwhelming. And so Everett. God bless him. He was a great guy. He took me under his wing, and he said, I think I can help you find a job. And there was a new firm starting up. The name of the firm was C&D Commodities. It was two guys, very famous locals down in the grain room primarily, Larry Carroll and Rich Dennis. And they were just opening a brand new firm, and Everett got me an interview at C&D, and I was probably, I want to say maybe the fifth person they hired there as they were starting their new firm. So I got thrown right into the fire from the very beginning and worked on, started as basically a runner, phone clerk on the floor of the Merc first in the old black box when the Merc was, in its infancy. And then worked there for a while and then moved over to the Board of Trade and kind of climbed the ladder at C&D pretty quickly just because I'd gotten in the door first. So it was, it was just a good stroke of fortune for me to have that opportunity. And I learned a lot. There were guys on the floor running the show for Rich Dennis, Danny Smith, Jack Callahan, those guys, always at work every morning, 5 o'clock, ready to go, great work ethic and set a great tone and a great example for me. So I lucked out. So I got into the turtle program really. I was running the floor operation in the grain room for Rich when he first decided to start this program, and he put the ad in the Wall Street Journal, and we'd come upstairs after the trading day was done, and there would be literally, gigantic bags, sacks from the U.S. Post Office in our office, and we'd have to kind of weed through the mail and sort it. And Rich and Bill Eckhart and some of the other guys up in the office would weed through these. And so, I witnessed the first round of turtles, if you will, that came in and saw how successful they were. Over the course of the next year, Rich decided he was going to open it up and do one more round and bring in another, half dozen to 10 more traders into the program because it was doing so well. So it was at that point when I went to him and I said, look, what's my career path at C&D going to be here? Am I going to be, going to the pit and get a badge and execute trades for you? Or, with this turtle program, would I be a candidate? And, what would you suggest if you were me? And Rich said, you can skip the floor because even if you get a badge and you go into the pits, you're going to get tired of that mentally and physically, after 5-10 years. So why don't you just skip that phase and go right off the floor and start to learn how to trade off the floor? So that made it easy for me. I said, well, if you would consider me for the turtle program, the second round here, why don't I make that move? I didn't have to go through per se the big long interview process and answer. Well, I guess I did answer the questionnaires that he put out there. Anyway, that's how I got my start in the business. It was just kind of a stroke of luck that, ended up being in the right place at the right time. And, obviously the turtle program and the opportunity that Rich afforded all of us was an incredible opportunity. It gave you the chance to learn how to trade and take the emotion out of it because it wasn't your money. It was Rich's money. As you know, that we used a high degree of leverage in the turtle program. So the opportunity to make triple digit returns was there, where, our margin to equity was very high.
I'm looking at your returns that I jotted down for while you were in the program. 85, 55%, 86, 116%. In 1987, you had the highest return of any of the turtles in the program as 185%. So yeah, you're right. You guys were shooting for big returns at the time.
Well, I actually, in 1987, I lucked out a little bit just because at the time I was, at the time, a little bit before I started the turtle program, I decided that since the trading day back in when I started on the floor, we worked from 7. Well, actually, we got in the office around 5, but the trading day would be done by, if you worked in the grain room, you were off the floor by 1:30. If you worked in the bond room, you were off by 2 o'clock. So I decided to go to law school down the street at John Marshall and get a law degree in the evenings. So I had a little time to study and then go to class. So I actually was literally the week and the days leading up to the 87 crash, I was taking finals in law school. And rather than worry about a lot of positions in my portfolio, doing my homework and working on the trading levels and stuff, I took a lot of my positions off or scaled back a lot of the positions going into my finals week in law school. When 87 happened and there was, a big disruption in the market, especially in the short-term interest rates and currencies, besides the equity market, I had very little exposure on. So I didn't take the gigantic hit that a lot of the other guys in the Turtle program. So that was a stroke of luck, actually. It had nothing to do with my exceptional brilliance or anything in that particular year.
Let me talk about one aspect of the program that I think is interesting and comes up to modern day a little bit. I think there's been a couple, I don't want to call them experiments, but some people that witnessed from afar the Turtle program and they wanted to replicate it. I think there was a British guy that was going to teach day trading to somebody or some group of people. But I think what people sometimes forget is that this program, depending on whether you came in the first year or the second year, was 4 years and 3 years. So this was a lot of time. And, I think people want to think that there's something to film. There's some sexiness to it. But, having a good strategy and sticking with it and having the discipline to stick to that strategy doesn't mean that there's a bunch of people in a room jumping up and down like the trading floor. And I think still to this day, people want to imagine some physical activity. And whereas I think you'll probably have added this, it's more of a cerebral game.
Definitely. I mean, it's, there's a lot of, when you're building systematic trading models, and you have, the blend of systems and you have your risk management parameters preset, then it's really, there's not a whole lot of excitement. You have some busy days, and in the old days we used to be on the phone a lot. You'd have to call the floor, you'd have to call, the sugar, the people in the softs pit, or you'd have to call the crude oil or at the board or the Merc. So you had a lot of phone calls to make trades when there was a big burst of activity, but a lot of time, there's just a lot of downtime so you could spend that time, either looking at new ideas or trying to test new ideas or, doing homework in some other area. So you're right. I mean, there wasn't a whole lot of activity or emotion, when the time came, having a disciplined approach. Actually, that was the hardest part, was to just have the discipline to do what the system, when the signals are generated. Sometimes it was counterintuitive. You'd look at it and say, I really don't want to buy the market up here. I don't want to sell this. I remember being short crude and taking a short position at below $10 a barrel back in, I think it was 87. So, that probably was the hardest part about what we had to do was taking some of these trades that were very difficult. And Rich always said, doing the hard thing is when you do the easy thing, you're probably going to lose. You do the hard thing, and it's probably going to turn out okay.
That confidence that was instilled at you at a young age, that's something that's never wavered. I mean, for example, in the last 3, 4, 5 years, it's been the latest rounds of systematic trend following, CTA style trading is dead. Now, from your perspective, going back to the early 80s, I'm curious, how do you feel when you see these stories? Because you're looking at the markets and systems from a much different perspective than what people that are not familiar with your style of trading. They see the headlines and they get excited by the headlines. But from a confidence perspective, really well deep in your gut, those headlines don't really amount to anything. It's all about the system, the rules, sticking with it.
Absolutely. That was, Rich said the two most important things you can learn from this program are, number one, you have to be very disciplined, manage your risk, take your losses, have an unwavering discipline when it comes to that. And the second most important thing is, when you're doing your testing and you're coming up with new trading ideas, new trading models, to just have some very robust parameters out there to make these systems operate. Honestly, I mean, our best systems now, if you have a system that has a 40% winning percentage over a long period of time across all the markets we trade, that's a phenomenal system. And so what that tells you is you're going to have more losing trades than winning trades. The discipline of letting your winning trades run and cutting your losses is where you make your money. It sounds simple, and you hear a lot of people say it, but the truth is, it can be a very difficult thing to do month after month, year after year. So when we do go through difficult periods for our particular style of trading, such as after '08 up until 2013, we had an up year, down year, down year, up year. We kind of went sideways to negative for quite a long time, the longest period I can remember in this business. And it would have been easy to kind of say, maybe our models are broken. Let's change things and let's move to, let's do things differently. And we at EMC decided, not to do that, we've seen these kind of periods before. You never know when the next successful period is going to come for our style. The financial engineering that was going on around the world, the central banks and the governments of the world propping up asset classes and trying to control interest rates and currency flows and things. They were obviously very successful at that, which made it difficult for us. But, we'd see little glimmers of hope of markets starting to diverge and follow their own kind of supply and demand, or, the other fundamentals that normally drive markets. And so we were cautiously optimistic that at some point, the long sideways to negative performance would end. And of course it did over the last, for us over the last 12 months. It's been, in our classic program, close to 40% over that time period. That's just the nature of our return stream. And if your investors understand that and they're comfortable with it and they know it's a long-term investment, they're going to understand we're going to have periods where performance is going to be difficult, but as long as you have long-term positive expectation, the benefits, obviously the non-correlative benefits of adding us to an investment portfolio really make it worthwhile for investors.
Brian, EMC Capital was started by a fellow turtle, Liz Cheval. She's unfortunately no longer with us, but I'm curious if you might go back and give some perspective about working with her, what she's instilled in the firm that to this day is still an integral part of EMC.
Sure. I mean, she obviously, we were friends way back in the early days, and we got to trade in the same room together and get to know each other. And she was always, a pleasure and a really a wonderful person. Over the years, after the Turtle program ended and everybody went out on their own, Liz formed EMC. Through her perseverance and her personality and her intellect, she partnered up with a couple of very good partners in this business, that being Dearborn Capital Management and Morgan Stanley. She cultivated those relationships very well over time, in addition to having great performance for them. Her ability to run a business as well as be a successful trader was, it's just a testament that EMC is still running here, even though she's passed now for 2 years. All those values were instilled in the people here at EMC. I've been here for 10 years, so I went off and did my own thing. I ran a CTA for a while. I went back and ran Rich's trading operation for a while. I moved to New York and traded for a hedge fund, a long-short equity firm for a while, and then came back to Chicago, met up with Liz, talked about our business. I ended up here, which was very fortunate. The carryover from the lessons that Rich and Bill instilled in us, still the same basic philosophy. You're looking to continuously look to improve your trading models or build new trading models that complement the ones in the portfolio. So it's an ongoing discipline of, continuous research, using the advances in technology to your benefit. So now, we've reinvested, enormous sums of money back into our infrastructure here in terms of research and trading so that we're at the forefront of quantitative analysis here. And then to have the discipline to to build systems based on trend following and momentum. It's always about directional price movement. It's never about, trying to pick tops or bottoms, and then implementing them in a way that, you spread the risk out across, the markets and the systems that you trade, get as much diversification as you can and manage your risk. It's really all about having a big database across numerous markets, lots of data points, daily data for 80 markets looking back, 20 years. So it's how do you efficiently and with a certain degree of speed, how do you look at all those possible variables when you're building a trading model that might have anywhere from, say, 8 to 13 parameters, the parameters being the type of price action that gives you initiation signals, the type of price action that gives you how to liquidate those trades, and then there'll be filters, there'll be filters in there that deal with things like volatility or delays or things like that. So, when you're optimizing a trading system using this newer technology, what it basically allows you to do is open your parameter sets much wider than you would have been able to in the older days when you did a lot of this by hand and then went back to the machine and had them rerun. So the biggest benefit is opening up the parameter sets and allowing the speed of the computers to just do multiple iterations, just millions of tests. It's a natural progression of the best parameters in the trading model rising to the cream rises to the top, and that's how you optimize your trading system. Obviously you have to be aware of possible pitfalls that come with curve fitting. To get around that, you don't optimize to one metric. You use a blend of metrics, and by that I mean you can mix a return element with another concept such as efficiency or Sortino or something like that. That's one way to prevent curve fitting. Another way is to obviously create an out-of-sample hypothetical return set and then compare that to what you actually were producing when you're re-optimizing existing systems or building new systems to see if actual trading mimics your hypothetical returns.
There still seems to be a significant number of traders, your firm included, though, that do have core trend or systematic approaches, trend following type approaches. And do you ever find it kind of amazing when you look back and you say, wow, some of these men that I learned from all these decades ago, and look, Richard Donchian before Rich and Bill and some of the other guys in the 70s, it's amazing that these core philosophies and many core strategies have continued to excel.
It's just a testament, I guess, to human nature. Markets are not always rational. They're not always efficient. On top of that, there really are things that drive markets besides human emotion, whether it be supply and demand or changes in technology or geopolitical events or some kind of economic upheaval. When those happen, a divergent strategy like ours, that assets are going to be mispriced across the board. There's going to be some sharp money flows in response to the mispricing of assets. The efficient market, when things are status quo and the world is not in upheaval, then you're going to have slow, steady, progressing markets. Over time, from one decade to the next, there's always the unforeseen, the unexpected, the sea change in one asset class or a number of asset classes that people have to react to, and you get long, pronounced trends. If you have systems in place that are designed to capture those, and you have the discipline to, say, get short crude oil at $100 a barrel, if it goes down to $80, a discretionary trader may, if there's a little bit of consolidation there, decide to take the position off, and then it may gap down $2 the next day, and it makes it hard to reinitiate a position the next day, unless you have that mentality that, this trend could continue much further than, I envision right now. Yeah, it's amazing that these programs, that, the old guys, the pioneers in our business envisioned working and experienced, they really understood the nature of the markets, and that there will be great profit opportunities in a wide variety of markets if you have the discipline to do it the right way.
They're not going to hand out the Nobel Prizes to traders anytime soon, I don't think. But all of the guys that get these Nobel Prizes, and some of them are extremely brilliant, I'm not taking anything away from them, but it seems like some of the traders that actually figured out all their lessons that they got the Nobel Prizes for long time ago already in the markets, in the pits, etc.
Yeah. Well, I think if you asked Rich or any of us, we're not anywhere close to being that deep of thinkers or that much in academia. It's just kind of a learning experience.
But it's the results.
It's more of putting your nose to the grindstone and doing the right thing day after day than coming up with some world changing.
Let me ask you about diversification. I received an email the other day, and somebody was asking me about the Swiss franc move in January. And I've talked about this in my podcast before. Other people have commented on it. And this person wrote me, they said, I don't understand these strategies, the quant trend type strategies. If they're trading the Swiss franc in January, how do they not lose 30 or 50%? And I think what people don't get is that, and I want you to comment on this and talk about this, is that you're not betting the ranch on each market. That's number one. And then number two, if you do happen to have losses, which you're going to have, there's also going to sometimes be gains, and the gains can offset the losses. Why don't you talk about that? Because I think that's a big picture concept that you might even face with. These days, I'm sure many of your clients get what you guys do, but still, there's going to be very bright, very wealthy people that still might not appreciate this idea that, well, we didn't get blown out on the Swiss franc because our position size was such that we weren't going to. And then number two, our other gains can offset. What do you talk about that, Brian?
Sure. Well, there was that was kind of a unique situation because of the peg that the Swiss National Bank had put into place. And once it got below that peg, and there were traders out there, certainly discretionary traders, who looked at it and said, what's the risk here? We got the ECB about a month away from their new QE program, if you will. So there were guys who looked at that and said, something could happen with the peg here. I'm not comfortable with this position, and just took it off. We didn't do that. We were still short the Swiss franc, but as you said, every trade that we take, there's a limit to the amount of risk that we'll put in any one trade, in any one market, in any one sector. The risk of ruin gets greatly reduced as you spread the risk out across 80 some odd markets across the globe. The Swiss franc only is going to get a certain small percentage of the total risk in the portfolio. Now, that said, for us, on the day of the decision to remove the peg, we were short. We lost a little over 2% in the Swiss franc that day, but at the same time, you have to remember we were long the Euro Swiss, which was the interest rate component of that. So the Euro Swiss actually that day and then for the ensuing week after that had a tremendous rally as the short-term rates went further into negative territory. So, we had the diversification to offset a lot of the loss that we took in the Swiss franc that day with some of the interest rate exposure we had there, plus being long the DAX, which has gone up about 25% since January, because of this QE program and because of what's going on over in Europe with, the attempts to stimulate their economy. The diversification really does play a role. The limit of risk in each market and in each sector that we trade plays a role. We've seen currencies go through pegs before, and we've seen, banks and central banks and other entities, say one thing and do another thing. So we really can't base any of our trading decisions on what, might happen or might not happen. Our models are really designed to react to what's going on in the marketplace rather than try to be predictive.
I have this jotted down in my notes here, quote, every now and then the impossible can and will happen, end quote. And it's such a simple thought, but how many of us go wrong on that, huh?
Yeah. I mean, every now and then you do get something that just defies logic. I wouldn't say this defied logic. It was just an event that, in retrospect, you can look back and say, oh yeah, we should have seen that coming, or oh, that would have been really easy to predict. But the reality is, in the moment, as you're looking at it, you don't know what's going to happen. And the Swiss obviously are very good at being secretive about what they do. So, for us, it's responding to, things that happen in the market rather than trying to predict the next black swan or trying to imagine the next gigantic price move in some market. You just have no idea.
I did not ask anything in the beginning of our conversation today, but I'm curious, looking back in time, how were you influenced by Bill Eckhart?
By Bill Eckhart? Well, Bill, was kind of the quant of the duo of Rich and Bill. I think Rich was the more intuitive trader, started in the pits and had a knack, obviously, for assessing situations and was comfortable taking risk and managing that risk, and obviously built a fortune. He recognized the brilliance of Bill and his mathematical approach to trading, and so it was a good partnership for them. You had the intuitive ideas that could be, or at least attempt to put those ideas into mathematical equations. And so it was really, I think their partnership was great, and that each one of them kind of had a unique contribution to the overall success of their partnership and of the Turtle program in general.
Yeah, I think we can all, maybe people aren't going to agree with me, but I don't think there's ever going to be a repeat of that particular event. I think the fact that it happened before the internet, where everybody wants cameras everywhere today and all that kind of stuff, I think it's just this naturally occurring event, seminar type program put in place by two men behind the scenes. And then when it was over, everyone learned of it and learned of the success. But I think it's going to be something where even 50 years from now, 100 years from now, people are going to look back and go, that was a really cool thing.
Well, being a part of it was definitely, the changing point of my life. So personally, I owe those two guys, really everything that I have right now. Is they put the programs in place and taught me some invaluable lessons and how to think about things and how to look at things. And so you're right. I don't know if there'll ever be anything quite like it. There might be something cooler that happens, honestly, in the next 10 years. For me, just being a part of it, with the friendships, I still see a lot of the guys out there, not as much as I used to, but we keep in touch, and they're, obviously everybody's program has evolved and changed over the years to one degree or another. I think, it's, just the nature of the business is how you're going to, or I guess the nature of our business, how you're going to position yourself, what kind of products are you going to build and offer in the marketplace. So, we're the sub-advisor of a multi-strategy 40 Act fund now. If you would have floated that by me, 5-10 years ago, we would have said there's no way we'll ever be part of a mutual fund offering. You just, you never know. Your business models and investor appetites ebb and flow and change over time. If you have a nice suite of products, if you will, that you can offer them, we kind of have a little something for everybody here, I think.
I'll leave you with this. I saw a comment recently and from one of your turtle peers and essentially said, hey, before we rule active strategies out, before we say that they're no longer valid, let's let the equity bull come down a little first. So I think it's interesting that even given the massive equity bull of the last 4, 5, 6 years, it's amazing to look at the performance from a lot of trend quant strategies, especially in 2014. Not everything goes up. I think it's going to be really interesting to see as the years unfold. And this is not a prediction or anything. I have no crystal ball, but I think everybody with a pulse out there knows that your type of strategies do extremely well when turbulence appears.
Well, historically we have, and I hope that proves to be true when the great unwinding begins to happen here. And honestly, it's impossible to decipher how it's going to unfold. Whether, when the bond rally finally ends, how it's going to end, why it's going to end. The equities will probably have an adverse reaction when that's happening. So it's going to be, we haven't been here before. So really, it's anybody's guess how it's going to, anybody can say it's going to end badly, but maybe it won't end badly. Maybe it'll be a smooth unwinding. Maybe it'll be, it'll just be markets will kind of go back to normal, and it's impossible to tell, honestly.
Your strategies will go either way, though.
Exactly. I mean, if there are money flows out of bonds and into other asset classes, we will be selling bonds and buying those other asset classes. Or, if the equity world gives back some of these extraordinary gains that they've built up over the last few years, then we'll be short in the equity markets and profit from whether it's a relatively short downturn or a more steep, dramatic downturn. You're right. I mean, we're positioned and our models are nimble enough to be able to turn and profit from any directional price movement in any market.
Brian, I can't keep you. I'd love to have you on again. Where's the best place we can send the audience to check you and your firm EMC Capital out?
Our website is www.emccta.com. And then, there'll be some information on our firm, our programs, and a way to contact me if you'd be interested in talking about our programs in more detail.
Brian, I appreciate you taking the time today. How's Chicago weather this morning?
Well, it got cold finally, but when I was walking the dog last night at 7 o'clock, it was 70-something degrees. When I walked the dog one more time at 10 o'clock last night, it was 50 degrees, and now it's in the 30s. So we're getting a little blast of cold, but, spring's right around the corner now.
Well, the next time you stop by Southeast Asia, I can give you a little dose of not cold.
Last time I was in Singapore, it was like 90% humidity in the mid 90s. And I thought, oh my God, I couldn't live in this. Walking down the street, I was drenched in sweat within 5 minutes.
I mean, the only thing I could wear are t-shirts. I mean, I can't, if I put a long sleeve shirt on, I'm dripping. Hey, listen, Brian, okay. Thank you for joining me. Take care.
Yep, Michael, thank you.
Today on the show, I have Christopher Cruden. Christopher has been in the trend following space for over 25 years. One of his places where he was introduced to trend following trading was at the famed shop AHL. Today, Christopher runs Inch Capital Management. A great conversation with Christopher. I hope you enjoy. Hey, listen, here's where I want to jump right in. Before we dig into your background, your current firm, and all that kind of fun stuff, I want to go back in time to something, a little nugget that I put in my first book, Trend Following. And I want to read this verbatim, and it's quoted to you. And it says, quote, "I would prefer to finish with a certain currency forecast based upon my own fundamental reading of the market and one that underpins my personal investment philosophy. The only problem is I can't tell you when this will happen or which event will be first. On that basis alone, it seems best to stay with our systematic approach, end quote. Okay, are we done our interview?
Yeah, that's about it, I'm afraid. I can't sing and you can't watch me dance, so that's about it.
That's a great line. And I did not know you when I put that in there. I just thought it was one of those nuggets I had saved. And I was like, it's just such a clear, and this is going back in time, and this is not new to you. You've had this attitude and this view going back to when? When did you become this man with this view?
When I discovered that everybody else I ever met was smarter than me, I thought I'd better stick with what I knew was an unimpeachable fact. And in terms of trading, that seems to be price. Everything else is some sort of weighted opinion or subjective opinion. And when it comes right down to it, I'm not terribly comfortable with besooted soothsayers and readers of tea leaves and chicken bones. So the price is the only reality. And so, I'm happy to stand at drinks parties and give people my utterly meaningless and worthless and often wrong views. They're not really based on anything, are they? And my suspicion is nobody else's are either. It's almost like a circus trick. You watch these economists on TV, the sort of talking heads, and some of them are very entertaining, very amusing, and some of them are occasionally right. But I don't think I'd spend money on somebody's view.
Was there a point in time, a trigger as a young man, where you could have gone down the Eugene Fama route, you could have gone down the Warren Buffett route, but you didn't? So what was the pivot? Why did you not do that?
When I started off with Deanwood Reynolds years ago, and worked under the Managed Futures department there in Graham Capital, and Ken Tropin and all of that sort of stuff. So we met a lot of really clever guys, but many of them were, it seemed to me, systematic trend followers. When I came back to London in '88, I had a friend of a friend who was a very senior person at a firm called Singer & Friedlander, and he said, I don't know what you do, but I know some people who do what you do, I think, as much as he understood it, because it was a very old British sort of stockbroker and that sort of environment back in the cities back then. He introduced me to Mike Adam at Adam Harding and Lewick. And it's a typical sort of British thing. Mike Adam and Marty Lewick had gone to a public school along with my wife's brothers, and, it was very, very British. I met Mike, and we decided that I would join AHL, and in those days there was AHL was AHL. I think we had a secretary called Eloise, and that's about it, really. And then Martin Hunt, who was a brilliant guy, who used to execute the trades. So I joined them, and then I got a call from Mike, and he said, actually, I want you to meet David. I said, well, that's great. I'll look forward to meet David. David Harding, this is. And I said, okay, fine. So I went to see David. And David was showing me on one of these huge, big CRTs that they had back then, which was color, which was kind of unusual, because we're talking sort of Pac-Man visuals here, but this one had color on it, had graphs on it, and his fingers would fly across the keyboard and another graph would come up, and then it would go into a heat map. Who the hell had ever seen a heat map? I mean, this is way before PowerPoint or any of that sort of stuff. I probably sort of looked askance at all of this, but what I was thinking was, could I do this? I mean, do I understand all of this? So I was looking sort of in a sort of a questioning way. And David sort of stopped and he pushed the keyboard away. And he looked at me and he said, are you questioning what I'm saying? Which I wasn't at all. Not in the slightest. I was in total agreement. And I said, no, I'm not questioning what you're saying. And he said, good, because we have the intellectual high ground on this. Which at the time I thought was one of the most arrogant things anybody had ever said to me. And having been in the British Army, there's a lot of arrogant things that have said, but this had a new record. But I thought about that. Over the time I was with AHL, they did in fact have the intellectual high ground because they were ferociously clever people. David, Michael, and Marty, as now Aspect, ferociously clever people. And sensible people too, despite the fact that those days were all less than 30, I suppose. What I realized from that moment was that I was not going to be as clever as them. So what I decided to do was to take the one kernel of information, the one nugget from my experience with them and my smaller previous experience and much of my later experience, is that simple works. So what was the simple thing that AHL and other successful trend followers do? It is limit the amount of inputs, limit the number of parameters, and have the discipline and the conviction to follow your system. And so that's what we do. And I know that in this business people dress it up all sorts of different ways, but when it comes right down to it, that's all we do. What we do is in fact pretty simple.
Let me ask the question, your differentiating point as a trend following trader primarily, the notion of going currency only, 7 currencies. This is your primary vehicle for applying trend following, correct?
Yes.
Talk about that. That's original. That's different, isn't it?
It was at the time we did it. After AHL was bought by Mann, I moved back to New York, and there was a man there called Bob Tomiso, who was my great mentor. He was an extraordinarily important man to me in my life and development. He was a systematic trend follower. His best mate was Larry Height. So Larry was always in the office and this, that, and we're talking 91, 92, 93, around about that time. Bob's CTA number with the NSA was something like 6 or something like that. So he'd been in it for a long, long time. And we noticed that at that time there were like 4, 5, 6, 7, 8,000 CTA registrations. And we thought that the business would become overcrowded, become overpopulated. We didn't like what we saw in some of the smaller agricultural markets and the metals markets and that sort of thing. So we thought we would, the belief was, and I say it quite often, but the belief was that markets take on the personality of the participants, and if the participants are overextended, overleveraged, easily excited, inexperienced, easily spooked, this is in fact a bad market to be in. So we looked for a market that wasn't that, and we found what was those days the interbank currency markets, which were by definition a professionals market. They also have even back then, the advantage of being utterly and truly bidirectional. Stock markets clearly aren't, bond markets clearly aren't. Some futures markets you would argue that are or are not to a greater or lesser degree, but currency markets absolutely are.
Truly surfing, right?
Yeah, absolutely. It's just long dollar yen is short yen dollar. I mean, it's not hard. And there's no cost or moral view or legal impediment. It's just they were perfect markets. And so they loaned themselves, because the serial correlation of currencies seemed to exhibit, to our kind of approach. So, and the product that came out was called Kintyre, which was, in those days we traded forwards. I think there were 28 different prices, and it was, in effect, it was a sort of a one-size-fits-all algorithm, believe it or not. And we're a bit surprised as people today to hear, but we never even had a price feed in the office. That's not just because Bob was cheap, but because it doesn't, watching red numbers change to green and back again isn't a particularly sort of constructive way of spending your day, especially if your holding period is as long as it was. So, of course, now it's entirely different. Now we've got all sorts of clever gubbins, which, as you've seen with the experience with Skype for this call, I don't fully understand. But nonetheless, back then there was none of that. So we traded once a day, as we do now, and everything was pretty simple. And the program itself was very successful. It had periods that weren't successful. Then it had periods that were extremely successful. I think in the 10 years we ran the program, we probably had 2 losing years. The worst one was, I think, down to 2.54 or something like that. And other years were 30, 40, 50, 16% or more. So a very successful program.
I saw one of the comments in your newsletter quoting the Doors line, "Riders on the Storm."
Yeah.
And noting that your program is something akin to a raincoat in bad weather. But that's not necessarily true in the sense that it's not only then that you can make money. I mean, you can make money.
Oh, no.
Yeah, exactly. So why don't you expand on that idea?
Well, in fact, that particular report, Riders on the Storm, I think we put that out about 15, 18 months ago. And we have just redone it. We've just redone the numbers. We haven't changed any of the words of the report because they're still valid and hold true. But we have changed or updated the files and graphs and charts and the numbers, that sort of thing. So we were early in putting that out. The benefit of a traditional portfolio, or specifically an equities portfolio, which is what Riders on the Storm concerns itself with, is entirely, from our point of view, accidental. It's an observed fact that exists with our program, rather than an objective that we set out to produce something. We didn't set out to produce something that assisted a portfolio of equities. It just so happens that after 14 and a half years, this is an observable fact. It does. It's sort of a happy accident that it does have this effect for equity investors. But it wasn't what we set out to do.
How do you describe operationally to investors? So we have a crazy period in the market, something like October of 2008, and your portfolio starts to do well. Equities are doing bad. But why don't you walk the audience through the idea of what's happening? You know, when equities start to go bad, people start to sell, and what operationally is happening that gives you the benefit to ride this increased volatility, this increased directional trending within your currency-only portfolio?
The answer to that question is to look at what are currency markets, and currency markets are basically markets for capital flow. So as there are seismic changes, such as a stock market declining 50% over a relatively short period of time, which they've done twice in the last decade or so, and vice versa. I mean, these are sort of big events. I didn't just mean the day of the quote-unquote crash, but I mean they are seismic events. And increased M&A activity, for example, it was very popular to ascribe certain moves to that sort of thing at one stage. What else would we have? The well-offers of the euro coming in, for example. Everybody knew what the targets were, so that's pretty much a layup. But these are seismic events that are reflected, or best reflected, in the market most appropriate for them, which is the foreign exchange markets. We don't make those things happen. We don't make anything happen. We just hope to hold on while nothing is happening, and for the time in which something good will happen, and we know as a certain fact that it will happen.
Have you ever had I'm saying this facetiously, have you ever had the Liechtenstein prince look at you and you say that you can't make it happen? Do some very well-heeled investors sometimes don't get that blunt, hey, I can't make it happen, but I'm still bringing you a very talented trading program with nice alpha generation, but oh, by the way, I can't force this to make money. Is that hard? That's hard for people to accept, isn't it?
It's very hard because it's sort of inhuman in a way, in the sense that people like to think they know a guy who knows something. And, it's hard if part of your presentation, or most of your presentation, is in telling them that you, in fact, are not that guy and you really don't know anything at all. So that goes down well with some and less well with others.
Well, I think it's once you start to open up and peel back the onion, so to speak, to get into the risk management, to get into the uncertainty, the volatility, how you're measuring things, how you're preventing the downside from going really down. I think it's when you start to open that up, I'm sure eyes start to perk up as well. Ears perk up.
Well, I think what we make a point of trying to explain to people that our job most of the time is in not losing money. I mean, as David Harding used to say years ago, you'll always make money in this business if you don't go broke first. And that's very true. Now, what's going to make you go broke? Well, being wrong isn't going to help. But most people go broke because of leverage. So we try and stay with very small leverage relative to most currency managers, that's for sure, and survive long enough to be around for the happier days. Like Bob Tanisa used to tell define trend following as this. He says, imagine that every day you've got to go to a Manhattan and you've got a junction on a street corner and you've got your folding chair and you've got your thermos of coffee and you've got your sandwiches and greaseproof paper and you've got to sit there. Well, the morning rush hour comes in and you get jostled around, and then it goes home in the evening, get jostled again around. They knock over your thermos, they step on your sandwiches. You've got fumes of cars going by all the day. The weather changes, da-da-da-da-da. And this is a terrible way to spend your life. Until one day, the parade comes by. And you don't know which direction the parade's coming from. But when it does come, you've got the best seat in the house. And that's trend following. The secret is to stay on that street corner.
When you compare, you can have that attitude in life, or you can have the other attitude in life, which to me, and I'm not trying to sound mean, but to some degree, when you're a pure, let's say, equity only buy and hold index person, index investor, you're kind of pretending that it's never going to go down. And you're very comfortable trusting the powers that be to manage those equities and keep them going up. But the objective evidence says we're going to have those 50% melts. So it's just, sometimes I want to use the word delusion. And I'm not trying to talk the trend following book up, so to speak, but I sometimes really wonder how this conversation doesn't open up more honestly to where both types of thinking can go onto the table. Because I think if more people understood the way that you think, Chris, the way that many of your peers think, I think a lot more acceptance would go down.
Yeah. Well, first of all, when we get to this point in any conversation, I would say, well, hang on a second. What are we using? Well, first of all, in my view, there's only two things you need to get right in investment management. One is benchmark selection. Always, always, always pick a benchmark you can beat. And two, time period selection. So if you, with the selection of the right time period, be it 1 year, 5 year, 1 month, 3 days, whatever it is, anybody can look like a genius. And much of asset management is based around that. So I'm not being sort of dismissive of people who say there is no tomorrow's prices, but basically these people are riding along in exactly the same way as they would say that we are riding along. They're only finessing it through benchmark selection and time period analysis. So that would be one point. The next point I'd make is most people would use, for example, in terms of asset management, a stock market index. Let's take, for example, the S&P 500. Well, the S&P 500 is, in fact, a trading system. It has certain rules, it has a certain number of criteria, and a certain number of rules. The most dominant rule or advantage that system has is has the survivor bias. I mean, I haven't noticed Enron being in the S&P 500 recently, or WorldCom, or things like that. So they drop out. So it's only when they're going up are they in. But that's fine. But we also know that about 80% of equity managers who use that particular index fail to beat it. And there are all sorts of reasons for that, and we won't beat them up on it. But, basically, if people are using that as a benchmark, they already, in my view, have surrendered to the wisdom of systematic rules-based trading, which, that we all know, they don't beat. So from when somebody says, well, what if this happens, or what if that happens, what if it does? I don't see how what we do is terribly different from the S&P 500 or any other index that people might want to use. I haven't been in the business quite a long time. I've heard so many conversations and so many arguments that, for me at least, the evidence is pretty clear and compelling. I mean, systematic trading works better than random trading. Now, I know about the monkeys and the dartboard and this, that, and the other, but the fact of the matter is, none of them have written Shakespeare yet. Systematic, simple rules. I'm not saying it's not possible, but none of them have, to my knowledge. There's been a lot of bad books written, but the monkeys have not yet written Shakespeare.
Your simple rules have some performance drivers. The performance drivers of your G7 currency portfolio. Number one, it's driven by the number of price reversals. Number two, it's driven by the number of losing trades. And number three, it's driven by profit size and duration of winning trades. Why don't you break those three apart individually for the audience?
First of all, if we wanted to, you and I, because we have time and we're bright guys, if we wanted to develop the world's greatest trading system, it wouldn't take us long. What we'd be aiming for is a 3-to-1 win-loss or 3-to-1 payout, risk over return, and maybe 50-50 win-loss. If we could do that, we'd have all the money in the world. I mean all of the money in the world. I don't mean large allocations, I mean all of the money in the world. We haven't done that. We have been unsuccessful in doing that. What we have got is we're about 60-40 losers over winners on average. In good times, it's better, and in bad times, it's not as good. But basically, 60-40 on win-loss. So 60% of the time, we lose on our trades. So when you look in the back of a commodity magazine, it says by our system, 98% trades winners. I'm, after 35 years, somewhat skeptical, but everybody's got to earn a living.
Hold on. You're telling me that if we buy those things in the back of the magazines that say 98% winners, you're telling me I am not going to be on easy street? Come on.
Well, I see a lot of young traders, well, not young traders, people come and say, this is the system. We'll introduce people, meet this guy, and you look at the track record and you say, well, Jesus couldn't trade that well. Yeah, it's just, I do this every day and have done for 30 years or more. Nobody can do that, in my view. There are periods of time when are better or worse than others, but some of these track records you see are a function of time period analysis, benchmark selection, and leverage. So from an investor's point of view, you have to be, I would think, extremely careful and somewhat skeptical going in. Now, so in terms of the... when our system basically has 7 currencies in it, 7 times 7 minus 7 divided by 2, so there should be 21 price streams that we trade. In fact, for reasons of liquidity, obviously, we don't trade all 21. We only trade 16 of them because 16 are the ones that meet our criteria for acceptable liquidity. Now, the computer doesn't look at them as currencies. Computers are clever things and useful things, but all it sees is a row of numbers, 16 rows of numbers. And those rows of numbers have certain characteristics and relationships with the other members of the portfolio. So, for example, if I say dollar yen to you, you immediately think of Abenomics, or if you think of euro dollar, you think, well, Europe's in recession and Draghi, and so the computer doesn't think any of that stuff. It's just numbers to the computer. So when we have these 16 rows of numbers, and internally we probably don't even refer to them as currency pairs in the conventional sense that most people do, because for us it is only price. Because price is the only reality. You look at the price, you say, well, that price is too high or that price is too low. And you might be right, for all I know. But that's the good news. The bad news is it doesn't change the price. The price is the price. And so that's the main input for us. And when we make a trade, and none of this is new or radical perhaps, but with Larry Hite, for example, all trades, as he said, I think in Market Wizards 1 year, never made a bad trade. Well, is that an arrogant thing to say? No. What he's saying is that all trades are risk equivalent. And why are they risk equivalent? Well, because if you knew that this trade was better than that trade, you would make that trade. You just make twice as many of this trade. But we don't know that. So all trades are risk equivalent. We bet small. When we win $2.12 or 20 cents, whatever it is, depending on the time equivalent of. And when we lose a dollar. So that's where our edge is. But it's a statistical edge. It's not a knowledge edge, if you get my drift.
Absolutely. Hey, let me clarify too. When you say it's just the computer, that computer is just you and your associates automating yourselves. It's your thinking in the computer. You're telling the computer. The computer's not wildly doing things that you don't know. You're simply saying to the computer, automate our thought process. Here's our systematic thought process. Now go execute it.
That's exactly right. We don't. What we've actually done is, in our business, is just chock-a-block with cliches. Here's a cliche. in our system, for example, our losing trades are held for about 6 days on average over the 14 and a half years. Our winning trades are held for about 17, 18 days. Okay. Now, in statistical sense, what does that say? Well, what it says is you cut losses and run profits. That's what it looks like. But the idea of doing that, cutting losses and running profits, is a trader's cliche that everybody knows, but for some reason, most people can't do. But it's not hard if you set very simple rules, and that's what we have encoded. But it's not rocket science. We didn't have PhDs here. I mean, I would take the view that all the best PhDs probably work for David Harding at Winton. So
he's probably the best one still, I would guess.
Everybody else is probably like either his cast-off or reject, so why would I hire a PhD? Because what we're encoding isn't, in fact, that hard.
Hey, listen, you mentioned the duration of trades. Your research, you've shown, though, the number of days for a winning trade appears to matter, but it's different for the number of days for a losing trade. Why don't you explain those differences that you found out of research?
When the system is not doing well, what you see is that the period is not because we're losing bigger amounts. There are two reasons that we lose money. One, because in the main, the losing trade holding period remains the same. It is the shortening of the winning trade holding period that is one of the most noticeable statistical phenomena of losing periods. So that's the one that becomes shorter, and of course that results in a higher trading volume. And having said that, our trading volume is positively Jurassic compared to most foreign exchange people. But when we in a bad period, you will find that holding period for losing trades remains approximately the same. Holding period for winning trades is foreshortened. But a bad period comes down to that for us, not because we took an absolute bath in this cross or a bath in that cross. That really doesn't happen to us in any sense.
And that's primarily, from having a rules-based approach and the most liquid of markets. This isn't like there's going to be some situation where you can't execute and get out of what you want to get out of or get into what you want to get into.
And that's why we trade what we trade, because if we were to trade, for example, and Lord knows we've looked at it 1,000 times and continually do, and even now we're looking at other currencies, but if you stick to the majors, or these in our case, these 16 crosses, there is a market for those. And more importantly, there is a price, because there is liquidity and you can have some confidence in the price. Yes, there may or may not be a gap, but it'll be a smaller gap than many other financial instruments that you can think of. So if you were to trade the real, or I don't know, the peso or the South African rand or something like that, well, now there is another thing other than price. There's politics, there's all sorts of things. Now, we don't have the foggiest notion how to measure political risk. We don't have the foggiest notion how to measure any risk other than price. And we take the view that if you can't measure it, you can't manage it. I'm not saying that other people can't and can't do so successfully, and I wish them good luck, but I know we can't, and therefore we don't.
Chris, as we wind down, I want to ask you one kind of fun question. I know you're a pretty pragmatic guy. I think the audience can see that, so I'm sure you're not sitting around wishing or hoping. But business would be even more interesting if one day that the powers that be in Europe decided that the euro needed to go back to what it was before the euro. That would give more opportunities, would it not?
Prior to the introduction of the euro, we only traded the Deutschmark as a proxy for Europe, and that has to do with correlation or changing correlation. So pre-euro, you could have theoretically 6 or 7 tradable currencies, but in times of great stress or difficulty, you'd actually end up with one position 7 times as large as you hoped it would be. Now, to avoid that, we only ever trade Deutschmark. If it went back to pre-euro currency, so lira and guilder and all that sort of thing, then we would probably take the same view that there is one European currency, and that would probably be the Deutschmark. In other words, we would reverse the decisions we took when the euro was coming in. But they certainly would be exciting and potentially profitable times.
It's an interesting perspective, though, that essentially you were already trading the euro before the euro.
I think we were, and I think many people were. I mean, as I say, what we do is it's not unique or clever. I mean, some people might think it is. I don't know, but to me, it's pretty obvious. This is not hard. I mean, you can discount a lot of things very quickly, or you can go on some sort of academic scavenger hunt and convince yourself that you're Einstein, which is fine. It's a big church.
I miss living in London. I miss the dry sarcasm, the academic scavenger hunt. I miss it.
Well, as I say, this is not hard. What is hard is doing it.
Yeah.
It's hard to come in and see that you've got another reversal and you've got another reversal and you've got another reversal. That's hard. But the reason that it's worthwhile is because when it does go your way, it goes like a train. And the reason that we take things like reversals and this, that, and the other, and we get whipsawed, which is a sort of no word of trend following, but it's because of what we know is, and I think maybe some investors don't know this, but if you lose $1, it's harder to make back that lost dollar than it is to make a new dollar because of volatility drag. For example, if I lose 25% in the stock market, I don't need to make 25% to get flat. I've got to make 33 1/3% to get flat. That volatility drag is really punitive. It is an additional price for being wrong. The reward for being right is not as great as the reward or the penalty for being wrong.
And I guess with clients also, the reward for being right is, well, you're not allowed to be wrong anymore. Just keep being right all the time.
Well, a rising tide lifts all boats. And, I think everybody, yourself especially, and myself and many others who do what we do the way we do it, we've seen this before, and if we live long enough, we'll see it again. A lot of people get it. We've got a whole generation now of asset managers, young guns who've come in and seen the stock market double.
Yeah, and that's their starting point. I mean, think about how many young people are essentially got started, young traders, professionals, and got started in early 2009, and their frame of reference is simply straight up.
Absolutely. Buy stocks, they go up.
Yeah.
Everybody knows that. We actually saw the similar sort of thing in the 90s, didn't we?
Absolutely.
And you find people who will say to you, they talk as if it's a God-given right to make, back in those times, 20% a year in the stock market. Hello?
I still remember the NASDAQ, what was it, 100% in 1999 it went up. It was crazy.
Absolutely. Yeah. Absolutely. And up it goes. And on average, you're making these huge returns. It's easy. Markets don't exist to make you rich. They're not here for your enrichment or entertainment. They're here to teach you humility. And that's what they do better than anything else that I've ever experienced. They teach you humility. After periods such as this, we forget that markets halved. Why? Markets are doubled. Isn't it brilliant? Let's talk. They're like a bad trader. You do it, just walk through a trader room, and the trader will come and say, well, you do so-and-so, that's great, da-da. But let me tell you, I bought the yen when it was da-da, now it's up. So yeah, okay, so you're telling me you're actually good trades. One of the parts that's missing from the conversation is your bad trades.
So, you're sitting here talking about humility, and there's plenty of young traders out there thinking, hold on, but really what's going on in the office, Chris? You guys are like all jacked up on coffee, and there's a huge adrenaline rush, and there's screens flashing, and everything's popping, and there's bells going off, and you guys are just going at it all day long. I mean, you're just not telling the truth, Chris, about how it really happens at the office.
Well, this place is like a graveyard. We don't allow anybody to watch screens. I mean, we trade once a day at London 1 p.m. And after we make those trades, we're done for the day. That's it.
But that's not a cavalier statement. That's just an objective, factual statement. But as we've been talking this whole conversation, there's a lot of depth of understanding that goes in to allow you to make that kind of objective statement. But you're not trying to be arrogant or like, hey, we only trade at 1 p.m. You're just saying this is a matter of fact. This is what we do operationally based on our system.
Yeah, well, it's the deepest, most liquid time for FX markets, point one. And point two is, again, it's something that we have to do it that way because that makes it measurable. If we came in and decided, for whatever reason, randomness would be a reason, to trade at a different time every day, well, that would be kind of more difficult to measure. So it's not arrogance. In terms of arrogance, I yield to no man, but there is a reason that we do things the way we do things, and I wouldn't for a moment pretend that other people don't have good reasons or better reasons to do things differently. As I say, good luck to them.
Hey, Chris, you guys put out a lot of great research, a lot of pieces of writing, and I know you talked about something I've not had a chance to see yet. Hopefully we can talk again here in the months to come. But where can people go to check out your firm, see some of the papers that you've written, some of the information you've put out? Where can people go?
Well, our website is www.inch.invest. Now, Inch is spelt with a C, so it's INSCH invest.com. Our head of research is Pernod Schneider, and although my name goes on it, and I take partial credit for what she does. In fact, most of the donkey work is done by Pernod and Rivaldi Kwan in London, and Philip Balich, who's also here in Lugano with us.
Is that more of the humility? What you refer to that the trading system and the efforts is the donkey work? I don't know if I've heard that one before, but I love it.
Well, there might be somebody who has a sort of a spark of genius, like the Sistine Chapel, the spark from the finger, and I would credit myself as occasionally I come up with a good idea, but rather like trades, most of my ideas are bad ideas. They have to be researched and tested, and Pernod, Rivaldi, and Philip do that. And so, again, exactly the same as I just said about a trader. Most of the things I think of fail to pass scrutiny in the end. But some of the research reports that do come out, we are often complimented on it. And the great thing about being us is that we're beholden to nobody. I don't have to trade through anybody. I don't have to do anything for anybody or to anybody. And I really don't care what anybody might say. So on that basis, we are pretty free in looking at what we would look at and concluding whatever it is that we conclude.
I think for the audience out there, whether it might be a potential new investor to your firm or an established investor or just a young person looking to learn from you and your associates and your work, go look at Chris's track record. Just go look at the monthly ups and downs, look at the annual totals, just look at everything and observe that it's not all black ink. There's some red ink in there. And I think that's what for me, I've always taken that when you look at a trend following track record and you look at that red ink, if you don't see the red ink, there's trouble. If there's no red ink, it's not trend following.
You're absolutely completely correct about that. And that's what I tried to allude to in the morning. I see some earlier in our conversation, I see some track records and I look at it and sort of with the one blink test fail. I don't think so.
Yeah,
I don't think so. And I hate to be cynical about this, but going back into those olden days, if people or clients are making allocations to trend followers, guess what? You see a hell of a lot more people describe themselves as trend followers. So, and extend that to managed futures. If managed futures does really well, guess what? Megabank PLC or whatever, they produce a managed futures fund. Do they know anything about it? Not a bit. But that's okay because they're paid on assets under management. Yeah. Do you see what I mean? If there is a demand, supply and demand, the supply will rise to meet the demand. And that's true of investment management. So if, for example, trend followers over the next 3, 4, 5 years do really, really well, you'll see a lot of people rebadging themselves as trend followers. It's to be expected. It's obvious.
As you mentioned that quick peak idea, I always say, and I've said this before, if you see a track record, and for example, I can think of 2 famous track records in the last 15 years, Bernard Madoff's, which was a scam, and long-term capital management's, which was just a bad process. But both of them showed you that consistent 1 or 2% a month. And so to me, it's like if you see and this might sound crazy to investors, if you see a track record that shows plus 1% for every month of the year, that scares me more than a track record that might show a minus 7% or a minus 8% a month. It's the plus 1% every month that should scare the bejesus out of you.
Me too, because it is simply not doable in my experience. You know, these, as I say, these places aren't there for your enrichment. And somebody who's going to make 1.25% a month and has done for the last 42 months, and I'm sorry, fill your boots, write the check. But for me, no.
When you see that track record, there's something else going on besides the track record. The track record is funky, to say the least.
Yeah. But there's a lot of it about.
Yeah. Hey, Chris, listen, great conversation. And I want people to go check out your website, check out your writings. And like I said, hopefully we can talk again in the future. And like I said, I go back to reading that opening quote that I put in my book. And my gosh, I probably found that 2002, 2003 when I first saw it. So I pulled it up today. I was like, I got to pull that quote up that I put in my book from Chris. So.
Well, since those days, which is a long time, it's got to be well over 10 years, I can assure you we haven't learned any more new things, but we've learned more about what we don't know. That's for sure.
Well, as you say, with humility, there's another humility statement right there. Hey, Chris, I appreciate you coming on today, and thank you again.
Thank you very much indeed, Michael. Thank you.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.